Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Yuri Khodjamirian, the CIO at Tema. Tema is an innovative company that is trying to revolutionize the ETF industry. The company has a passion for providing investors, especially those in the retail space, with access to institutional quality managers and strategies. In this in-depth discussion, we covered Tema's mission as it relates to providing quality access to ETF strategies, how Tema is trying to differentiate its ETFs within a very crowded space, what some prominent venture firms thought was so attractive about Tema to warrant an investment, the strategy behind the Tema Monopolies and Oligopolies ETF, ticker TOL, and his approach to establishing an edge in well-known stocks. For full disclosure, I do not own any of the ETFs that Tema either runs or has helped build. And without any further ado, here's my conversation with Tema CIO, Yuri Khodjamirian. Yuri, many of our guests are not going to be familiar with Tema. With that in mind, I would love to hear the founding story and understand what market opportunity within the ETF world Tema is trying to exploit.
Yeah, Ben, thanks so much for having me on. Really happy to tell you about that. I think, look, Tema started a couple of years ago, about 2 years ago, by our founder, Moritz Pott. And he really saw an opportunity in the ETF market where what he saw was a real gap of bringing kind of institutional grade strategies to the ETF market. And he saw that as a big change. As you might be aware, in 2019, the SEC changed the rules, which really ushered in the era of actively managed ETFs. The ETF is really a wrapper for funds, and you can put whatever strategy you want into it. And we saw an opportunity to really build the first and hopefully the largest independent institutional grade manager of ETFs. And this is really the white space that we're going after. And so if you think about the way the ETF market's evolved, right, it's a $10 trillion market, but the vast majority of it is passively managed. And a lot of the strategies are what we would say not the best in terms of the outcomes for investors. They're focused on marketing. They're focused often on the hottest thing or the hottest trend. And this is really because of the heritage of the ETF market, which is more retail, more sort of bringing access to different strategies, but not necessarily a lot of thought goes into the quality of these strategies. And what we're trying to do is just be different and bring this sort of institutional grade. And that by that, we mean institutional risk management systems, institutional kind of grade managers as well. So people who have 20, 30 years experience over multiple market cycles. And we think that hopefully this will disrupt the market in a way and create a kind of a new player, which is what we're trying to achieve with Tema.
Why have the managers that you're thinking about working with and talking to and the strategies that they run, why have they not been interested in ETFs? Was it all about the regulations, or are there any other reasons why you think ETFs were seen as not a viable vehicle for certain managers?
Yeah, that's a really interesting question. So we straddle kind of both worlds, right? So we're trying to address what I said previously in terms of taking on the ETF world in terms of their kind of marketing and passive focus. But equally, if you look at the institutional world, their preferred vehicle has really either been a private fund or a mutual fund. And I think what's happened is that those businesses have grown really big over time. And they tend to charge higher fees. They tend to benefit the manager more than the investor. And we think that that's under assault now, partly because of the regulatory change as well, but partly because investors really prefer ETFs as their vehicle. There's surveys being done now that if you ask RIAs and even retail investors, they want their active and their passive strategies delivered in ETF format. And if you actually think about the generation of new investors that entered the market, let's say in the last 5 years, especially with the rise of apps like Robinhood and Revolut here in the UK, but other companies as well, What they're trying to do is kind of give access to the stock market and to the investment world in the easiest possible way, right? You take out your phone, you have an app, you can just buy whatever investment products. The problem, of course, is though they're terrible investment products so far, especially in the ETF world. And if you think about the institutional managers, they're sitting in their mutual funds, they're earning higher fees, and they're not, they've just been a bit slower at accessing the ETF market. And they're slowly realizing that this is the preferred vehicle. And many of them are entering the ETF market. But as we've seen before, incumbents tend to be a bit slower. They also tend to like to keep their profit pools. And that is, I think, why there's this room to create a new asset manager in this space.
You mentioned the word access in that previous response. I was looking through your presentation and you distinguished between simple access versus quality access. Maybe you can describe what you mean by simple versus quality access.
Yeah, so it's something that we believe is kind of core to our mission, right? I think if you think about the sort of first chapter of the ETF market, it really was about giving investors access, but it was very simple in its nature, right? It was the SPY, it was QQQ, it was passive products, and it was really about getting kind of simple investment strategies for the masses in a way. And what we think is kind of the second chapter is really about this idea that can you get very, very good strategies that previously weren't in the ETF world, and get access to those strategies. And that's what we're doing with the investment team that we've got on board, and also selectively working with other managers as well. The idea is that if you can give them access to a strategy that they previously weren't able to get, that is what we believe is quality access. So you're trying to give them something really, really good rather than just giving them access to an investment that they could get from another source, but it's just a very simple structure in terms of an investment product.
And if I'm a manager that has a mutual fund that's charging, I don't know, 100 basis points, or a hedge fund manager that's charging some version of 2 and 20, right? I think people have this perception that ETFs are lower cost. Why would I want my strategy in the hands of people who have much lower expectations for what it's going to cost to manage it?
Yeah, I mean, that's a great question. I think there is a realization that the ETF has a lot of other advantages over some of these other structures. And those are the advantages that investors want, but also mean that that's where the demand is, right? And so what we think is that generally, if you take an ETF, there's a single unitary fee. And I think a lot of investors really like that. They like the idea that there's just one single fee. Whereas if you look at a mutual fund, there's sort of all kinds of other costs that get charged to the fund, which as an end investor, you end up paying, 1.2, 1.3% sometimes for these investments. So the investors like that single unitary fee. They also love the tax advantages of ETFs. As you know, an ETF allows redemptions in kind and also creations in kind. And that means there's no taxable event for the holders of that particular fund when there are flows in and out of the fund. And that means it's a massively tax advantage. And that tax advantage is really something investors want. And so you're kind of getting at what I'm getting at here, right? Which is investors or fund managers need to go where the demand is, right? And the demand overwhelmingly is the ETF is the best possible wrapper for these strategies. It does mean that the fees are going to be lower for these managers. And that's why we believe that a lot of existing large asset managers are probably not going to rush headfirst into this, right? Because it's a cannibalization. But it's almost like the reality of the marketplace out there. I mean, I can go as far as making a very bold prediction, which is that in 20, 30 years, maybe mutual funds won't exist as a structure, that all strategies will be presented as ETFs. And that generation that I mentioned, they're just used to being able to open their phone and see immediately the price of every one of their investments. As you know, mutual funds, they price daily, they settle a couple of days later. It's a different kind of mentality and a different generation that's passing through the investment journey. And really that generation is much more interested in these products. The other thing that we think is that by giving access to this investor demand, you're also creating a much more sticky, much more democratized asset base for some of these investors. So yes, you might be taking a hit on fees, but actually you're building a much longer, much more durable product because it's in the right vehicle, a vehicle that investors want. And it also gives you access to this retail market, which you may or may not be getting with the mutual funds. It's a bit harder. And that retail market is something that we think is a lot stickier, a lot longer term than maybe some investors have thought previously.
Got it. The last, and this is interesting. This is I'm learning as we go here, and so I'm going to throw one more question at you about this because it seems like you have a really interesting vision, and I think you've got, there's some vanguard in the blood here where you're trying to disrupt, kind of a legacy structures like a mutual fund. But if I'm a manager, my concern is that an institutional investor is paying one rate, potentially with a base fee and a carry, and then in a situation where you have an active ETF where we have whatever the overall fee structure is lower, you have what I would call channel conflict, where if I'm an institutional investor, I say, why am I in this strategy? Why wouldn't I just go to the ETF? And so you really have to be willing to self-cannibalize. Is that an accurate description of what someone's going to have, like how forward-looking someone's going to be able to, to survive in a world, the world you're describing?
Yeah, look, I mean, this is why we think that there's this enormous opportunity to build an independent, large asset manager in the space. Because one, you're probably not going to do that. If you're going to do it, you're going to do it very, very slowly. I think that's the first problem a lot of these legacy, let's say, asset managers are going to face. The second problem they're going to face is distribution and marketing, and how to get at the end investor, because that is by far not a trivial problem, right? The reality is that they're used to doing things a certain way, but those things don't really apply in the ETF world. And they're going to have to relearn how to do that kind of marketing and distribution. And that is going to be difficult to do. And it's easier to build it from the ground up. So we sort of see this opportunity to build a disruptor in this space because I don't think a lot of the existing asset managers are going to do it. Now, what is definitely happening is a lot of existing asset managers are maybe converting mutual funds over to ETFs, taking the hit on fees and realizing that actually, you know what, I'd rather be in the ETF structure. Most notably, DFA have done that, but there have been others like JP Morgan and Morgan Stanley. That is definitely going to be happening. It's just not going to happen fast enough. And there's going to be this middle ground of asset managers that aren't going to be able to do it. And then on top of that, if you layer the challenges of having to deal with a new operational structure that you maybe didn't have before, then a new distribution channels that you previously didn't have to get access to, and marketing channels as well. Like one of our key features that I think is one of our biggest strengths is our marketing abilities, right? In terms of accessing digital channels, understanding how this new generation of wealth is thinking about investing and getting at those people. That is, I think, a real differentiator and why we think this is going to be a long-term business and one of the largest ones in the asset management space.
I get the almost like a tech vibe here with the idea to disrupt a legacy industry. So, and I think it's interesting when I look at the groups who have supported you, individuals and venture farms. They look like, this could be a SaaS startup of some kind in terms of the investors you've attracted. What do you think they see in what you're building? Like why investment management for them? Like why is that a space where they think there's room to build disruptive businesses?
Yeah, obviously, as you're alluding to, we're backed by Index Ventures and Excel. I have some of the sort of best fintech investors in Europe and definitely in the United States as well. And a lot of kind of former CEOs and I would say like the glitterati of the asset management world. I think what they see is they see a real opportunity for this kind of first independent institutional grade ETF asset manager. They understand very acutely the challenges that we just talked about there because they've lived them in their business and they've seen Vanguards and BlackRocks chip away at them with these passive, maybe marketing-led products. And now they're seeing their active businesses also under threat. They see that as a big opportunity. They also see this opportunity of us building this kind of turnkey solution for kind of non-ETF investment strategies to be put into the ETF vehicle. they think that that's a really exciting place. And it is something that we're building as part of our business. And it's all part of the same mission. The mission is, can I bring really, really good strategies to this client base that previously hasn't been really well served? And I think this is really, really important, right? The way the venture world looks at fintech, they think about it in this way. They think, the Robin Hoods of this world were really the supermarket shelves, right? And suddenly what they've done is they funded this kind of these kind of super apps which have all the investment products on there. But what they're realizing very slowly is that they've given millions of people access at a very, very cheap way to invest in the market, but they've actually not given very good products, right? And so what they're thinking is, could we back the next generation, which is going to be thinking about what products go onto those shelves? Mm-hmm. And that is really going to be in an ETF vehicle through these new distribution channels. And that's what they think. So it's kind of threefold, right? The first independent institutional grade ETF manager out there, a turnkey solution for non-ETF investment strategies to bring them into the ETF vehicle. And really this idea that can we build really great investment products with great investment outcomes for this new generation of investors that we've empowered by giving them access to the market in their pocket.
I think that's a really good foundation for us to build off of, to have the rest of the discussion. And so maybe we'll dig into what you're doing and what you've done to date is maybe the better way to say it. So if I look at this slate of ETFs you've already launched, it's really innovative. I'm just curious about where the ideas for the new ETFs you have launched, where did they come from?
Yeah. So I think it's something that we're really proud of, right? The current slate of ETFs that are out there. They're really the sort of proof of concept of a process that sits behind the scenes in terms of understanding, okay, what ETFs are we going to launch? Why are we going to launch these particular ETFs? I think in terms of the ideas, it's very much like stock picking, right? We're trying to be serendipitous in our approach to kind of generating these ideas. You want to be open to the world. You want to kind of look at everything and every possible situation. That's how you should come up with good ideas. The other thing you want to use in terms of coming up with ideas, again, very similar to stock picking, is modern technology tools. So we've built a machine learning system that kind of looks at the world of ETFs and figures out where's all the white space in terms of interesting ideas and themes. But we are very, very rigorous in trying to figure out which ETFs we're going to launch and which areas and strategies we're going to go after. And we do that through quite a rigorous process. And the process focuses on a couple of things. It first focuses on the investment merit. And I think this is really, really important. At the core of these strategies, if you're going to call yourself institutional grade, you better be thinking about the long-term investment merit of these strategies. And that is really at the foundation of these things. You've probably seen over the years, people launch ETFs frankly, with very, very little investment merit. They might have marketing merit, but they have little investment merit.
Sure.
I'm talking here about things like metaverse or meme stock ETFs. These things are just taking advantage of short-term momentum, and usually they have a bad outcome for investors. So we're going to have long-term investment merit. Of course, they also have to have a simple marketing message, the one line that's going to capture the attention of an investor. And the third thing is that they need to be sellable, and operationally we can deliver these products. If they all meet these criteria, the other thing that we try to do is we try to go after big areas of the market. So not like this very, very niche areas. Sometimes you see this in ETFs where you might go for something like very, very specific, like pet insurance. And there's just not enough companies and not enough market cap to make a proper investment opportunity. Sure. And so what we're trying to do is be like, okay, what are the really solid investment opportunities out there? What are the most pressing, interesting strategies and themes? Can we market and deliver and sell these particular products? But also really just trying to understand, can we bring what we're trying to bring, which is institutional grade systems and ideas and processes? Can we get great management, great talent, great risk management? And can that add value to what else is out there for these particular themes? That tool that I described earlier, we use it to figure out what's the real white space opportunities out there, right? We don't want to get into crowded themes where we think we can maybe do a good job, but actually there's just too much competition out there. So it's sort of, the great message that we're trying to deliver gets drowned out. So our first crop of ETFs are all the first in their particular category. And they're also the better product, right? Because this is an active manager actually looking after your money in that investment strategy.
And whenever you're launching an investment strategy, right, you have to have a sense of how big does it need to be sustainable and profitable and successful. Sounds like you guys use a lot of technology. Maybe that limits the structural cost base of the firm. But I'm just curious, as you're launching an ETF, like these days, what does it cost? What kind of AUM do you need to be for it to be profitable and sustainable?
Yeah, so obviously I'm an investment guy, right? I'm not that close to the numbers, but I think in general, ETFs are probably high cost upfront in terms of having the structure, the ETF trust, and all those things, which creates a barrier to entry to other people entering this market. But then each incremental ETF has a lower AUM hurdle to start being sort of contributing, if that makes sense. But you do need to scale these products, right? Launching these products and not being able to scale them to sort of the 50, 60, where the million kind of range where they become sustainable is really kind of a fool's errand, right? And that's why we do so much work up front. When I'm talking about this process, these are 20, 30-page memos that we write with analysis on every possible kind of scenario in terms of the investment side, the valuation of these themes or these strategies, is there momentum? Is there loads of hype? Can active management add value? Is there a dispersion of returns of the stocks? Can we market these? Is there real interest from investors out there? Is it really sellable? Are we solving a problem for clients, right? For RIAs, we're talking to their clients in their portfolios. Where does it actually fit in their portfolios, these strategies? And if you do all of that work, you're hopefully setting yourself up to success. It's the same thing with stock analysis. If you do the work up front, it makes it a lot easier as you go test it out. But of course, not everything is going to work out. And that's the key thing, right? Our first initial crop of ETFs is very much a proof of concept to try to understand, are we good at this? Can we figure this out? Can we grow them? And so far, we've had quite a lot of success with several of our ETFs in terms of getting to that number already.
And you mentioned the idea that you believe that the way you're managing them is better and they end up being better products. What does that mean? Like, how do you evaluate better? Is there some valuation aspect? Is it concentration? Like, what implies, what implies better to you?
Yeah. So let's take like a thematic ETF as an example. And as you know, we sort of split our strategy in we're focused on healthcare and life sciences. We're focused on strategic equity, and we're focused on alternatives as well as a next chapter part of what we're trying to do. But if you think about the life science funds, for example, a lot of the times in the ETF market, you have two major problems that ETFs face. The first is what I call a problem of purity. You think you're buying a theme or you're buying a particular life science exposure, but you're actually getting exposure to a load of other companies that are not precisely getting benefiting from this mega trend. And no matter how good some of these index providers and these passive funds are, the reality is that there's no replacement for having a very serious investment professional look at this space, build a proprietary universe of stocks, and start picking from that universe. And so we pride ourselves on kind of a purity of exposure to some of these particular themes and strategies. The second part is about risk management and quality. If you look through our investment process, it really runs as a line through all of the things that we try to do. If you're buying something like life sciences, you're exposing yourself to long-term growth. And we've picked 3 therapeutic areas, most notably cardiometabolic and obesity, right? We all know the rise of weight loss drugs and the real transformative healthcare power, which has been proven in clinical trials now, this market. Analysts are kind of scared to put a number on it, but it could be in the hundreds of billions now. And we think it could be even higher than that. But what you want to make sure is you don't fumble it, right? And that's often one of the things you probably heard from many of your other guests is in investing, you got to pick the right thing, but just not mess it up. Taking care of the downside risk is just as important. And what we often see is in funds where maybe purity is not a problem, actually the quality of the companies that they've got in there is really, really bad. And so you're going to lose, but you're not going to win, right? The trend is not going to trump the quality of a particular business. And there's so many examples of this across the marketplace in ETFs. And so what we do is you have a professional manager, active manager, 20, 30 years experience. And Dr. David Song is the example here in the life science funds. He's been looking at the space. He's been through multiple biotech cycles. He's been through multiple clinical trial readouts and all of these things. And that experience is really guarding you against the quality lapses that happen in other investment products. So for us, that's what we mean by better products, right? Much purer exposure to these long-term powerful themes like life sciences and obesity, and much better quality and risk management control than you have out there in the ETF market. And that's what we think is firmly going to deliver better outcomes for investors over the long run.
And in terms of the target market, you mentioned retail investors a few times, but you've also highlighted and hinted at the idea that you're trying to build institutional quality products. So maybe bifurcate the market a little bit. Is this mainly focused on retail? Do you think these ETFs you've launched so far can go both ways and be valuable to institutions as well? How are you thinking about that?
Yeah, I mean, look, what's amazing about the ETF market is that once you list an ETF, it automatically turns on in everyone's investment apps. You know, whether you're on Interactive Brokers or Fidelity or Schwab, it's there and it's available to buy. And that means that you have instant access to a retail audience, but also to an investment audience of advised clients, right? And so we think that the great opportunity early on for investment products before they've established their long-term track record and the pedigree of the manager comes through is in the retail space and in the space of RIAs, so registered investment advisors. And what we see is that these advisors are very interested in one, differentiated strategies, right? They love the fact that we're coming to them with people who have worked at Millennium, Balyasny, Nuveen, other companies like Goldman Sachs, where they previously haven't seen that level of quality of talent within the ETF world. And so they really like that. And that's what we're trying to get after, that sort of differentiated picture for those client base. So you've got your retail, you've got your RIAs, and I think that's the initial kind of set of capital. As you build as a business and you hit certain AUM thresholds, you just get access to bigger advisor groups, the so-called wirehouses or independent broker dealers. And there, it's very, very important to sort of go in with interesting strategies, right, that are different to what's out there. And that, I think, is where we have a great position. If you take, like, for example, our oncology strategy, I think there's a great interest from wirehouses be like, okay, that's very interesting for us to really connect with our clients, right, to give them an investment product that is really well managed, exposed to a theme that unfortunately is not going away anytime soon, but also one that is helpful, right? It's like you're helping companies, you're investing in companies that are doing something good in this world. And so what's happening is that these wirehouses are kind of talking to us and saying, we really want these investment products. So once you hit a certain level, that's where you go on and you go onto the menu and you align with the vision of the central kind of CIO office there, and you move on and sell your funds, right? And then over time, of course, what our ambition is the institutional market. And what's really fascinating, Ben, is that the institutions are also starting to adopt ETFs. They like ETFs because not the tax benefits, so often they are tax sheltered investors, but they like the transparency, they like the ease of use, they like the fact that they can trade in and out of these, that there's a primary and a secondary market, there's loads of liquidity in the way they do these strategies. And they just like kind of these products, right? Both as trading tools, but also as investment tools and also as long-term holdings. And so we're seeing very, very serious interest from large pension funds, endowments adopting ETFs as the wrapper. And that's where our ambitions really lie as well, to address that market. But you have to build products that are institution grade from the beginning, right? You can't build a meme stock ETF, get the attention of retail, and then you'll never be able to sell it to institutions. So that's what we think about the kind of ladder of distribution out there.
And you can have an ETF that's better and differentiated, but if no one ever hears about it, your AUM never grows and nothing good ever happens. So you talked about digital marketing, you talked about being, that kind of maybe being a little different than a lot of managers and really tapping the digital space. Can you talk about the general approach to sales, marketing, and distribution, and how how you expect someone to hear about one of the Tema ETFs?
Yeah. So look, it's a multifaceted strategy. You need to be out there First, you need a great product. That's important. But also you need to be able to tell the story of the product in a simple way that connects with the end investor. And that's what we're really trying to do. Life sciences, the Monopolies fund, American Reshoring, they connect with the investor in terms of the understanding of these strategies. And that connection is really, really important. And that connection you can foster through marketing, but also through content. If you go onto our website, temaetfs.com, you'll see just loads and loads of content that we've produced. And this is deliberate. What we're trying to do is educate, enlighten investors about the themes and about the market in general to help them understand that these are the areas they might be interested in investing in or not. And we're obviously also always cognizant about the risks that you're taking, right? These are equity strategies, concentrated. It's important that you balance the risks. And that's what a lot of the education and insights that we're writing about. You can subscribe to our newsletter. We're always sending stuff out. We're quite prolific about that. And I think that's a really important strategy there, getting content out there and making sure that that content is something that resonates with people who are reading it at the other end. And similarly, you want to get strategies where you're sort of out there at those touch points with retail investors and RIAs. You're basically helping them understand the market, helping them invest in these products. And that's what a lot of the strategy is about. So we employ a lot of modern digital marketing tools. It's helpful to think not like an asset manager. Now, we're in a highly regulated environment. And of course, everything we do is absolutely by the book and follows all of the rules set by the SEC and FINRA. But within those boundaries of that regulated environment, there's loads of strategies that you can employ, that you can borrow from other areas that have been successful at reaching this retail customer or the RIA customer, that a lot of classic legacy asset managers just don't know how to do. And that's what we think we're going to be able to win. And that's what we're deploying out into the market right now.
I think it'd be helpful to dig into one of the ETFs to get a flavor for what Tema's trying to accomplish. In that last response, you mentioned the Monopolies ETF. The ticker there is TOL. Maybe you can describe the strategy there for people.
Yeah, so obviously as CIO, this one's close to my heart because I actually manage this strategy. Look, TOL buys, in very simple terms, dominant, tangible, and durable moat companies. The idea is actually fairly simple. The idea is, can I buy a company that has a high return on invested capital, but I'm very, very confident that that return on capital will sustain over a very long period of time? The only way you can do that is if you buy companies that have high barriers to entry, and companies that have effectively this term that was popularized by Warren Buffett of moats. Now, we think that there's loads of people out there that talk about moat investing, but if you actually look into the literature and really understand what are the companies that are going to be really durable over the long run, what are the companies that are maybe going to come and go and are a lot more disruptable, especially in the modern world, you start to realize that you need to focus down your moat investing. And that focusing down is really companies that are dominant, hence the name Monopolies, but also where the moats are tangible, right? You can actually feel them, like you can really understand what they're about. And obviously the opposite of that, what I'm saying is we don't really invest in intangible moats. So things like brand and some of these technology companies, and we think these moats are actually quite flimsy and a bit weaker than a marketing. Sure, these companies are earning high returns on invested capital, but they could fall over at any point. And then finally, we start with durability. I'm razor focused on making sure that there's a longevity to this return rather than say something like a wide moat where, yes, sure, the moat is high, but is it really durable over the long run? So that's what TOL is about.
And as I look at the sector weighting in the portfolio, I see that about a quarter of the portfolio is tied to the data industry. So building off that last response about durable moats, I'm curious about why you find a lot of monopolies in data and what you find so attractive about the business models you see in the data-oriented companies.
Look, I love data businesses and especially financial data businesses. And the reason for that is actually, you'd be surprised of me saying this, is one of the reasons why I'm so bullish on it, is why it's such a high weight, is actually AI. We can talk back and forth about whether AI is a hype or not, but I think in reality, it is going to change the paradigm in computing. But what's really, really interesting about AI is that it's going to change the relative value of computing power and data. What I mean by that is that effectively compute or software, and it's going to be much, much easier to write with AI. I mean, it's really the first use case as we've seen. And this is going to mean that we're going to see a much bigger proliferation than we've ever had before of computing and software in the world. And therefore, its cost is going to collapse. And as we all know, as investors, we have to look for the areas of scarcity within that world. So what happens is you see a relative value shift, and the real scarcity, especially for these AI models, but in general, is data, and not just any data, high quality, trusted, very, very well put together data. And that resides within the financial businesses. You take a company like Moody's, they have the world's best and biggest database of companies, private and public. It is enormous. And Moody's also has loads of credit data as well, right? They sit as a software on every credit decision maker's desk in the world, right? All the banks, especially in the United States. And so they're collecting that information, and there's just no other company that's collecting that information because they're not there at that decision point. And that data and its quality is really, really valuable for all of these models that are going to be built in the future. And that's why we're quite bullish about all of this. We think the relative value in the market is going to be there. There are other areas, of course, of relative scarcity value that we're also invested in from this AI revolution, but we think that that's the case. And it's a moat, right? Moody's owns that data. No one else is going to be able to rebuild that database. And every data point that gets added makes that database much, much more valuable than others. And that's why we've decided to make it a very big bet in the portfolio.
I see you have about 32 holdings. How do you come up with the desired level of concentration for Toll? And then maybe you can also talk about the other funds if there's a difference in process there.
Yeah, so this was actually an area that I spent quite a lot of time on early on as we were setting up the firm. One of the ideas was, look, we have a blank slate here, right? We can build an investment team how we think it should be built properly. And one of the key areas is portfolio construction. What you do realize if you look at the literature and data is active managers are fantastic at picking stocks. That is really where most of the alpha. And actually, if you look at some of the data for the best managers, more than 100% of the alpha generation from these managers is in stock selection. Actually, portfolio construction tends to be a negative alpha contributor for most great managers. And if you go out into the industry and read literature, there's actually not a ton out there of really concrete rules about, okay, I picked the stock, but how do I size this position? And so we did a lot of work talking to lots of participants in the marketplace, reading the academic literature, and we tried to come up with an approach that really tries to get rid of that negative alpha and really harness that stock picking alpha, but also combat behavioral biases and risk management as well. And that approach is really what leads to the output, which is these 32 holdings, right? But what we're trying to do is we create tiers. So we have conviction-based tiers of portfolio sizing, of position sizing. Within each tier, it's basically equal weight. And what this means is that you have very nice behavioral benefits. You don't overtrade. You tend to need to put on a higher minimum position instead of having really small minimum positions. And you have maximum position limits as well to limit risk management. And we think so far it's worked really well. We've done some analysis. It actually does work as a way, and it creates these guidelines, which we call kind of active systematic guidelines around the stock selection, which hopefully gives investors the best possible outcome without giving them the negative sides of it. And that's how you get the result. And this is across all of our funds, maybe a bit less in the biotech world, where funnily enough, the best strategy there is conviction-based tiering, but with a look towards market cap, which is the best indicator of, I guess, a more established company. You don't want to take 4 or 5% positions in pre-revenue biotechs. I think that's a recipe for a badly risk-managed product. And so, but broadly, we apply this portfolio construction process to all of the strategies at Tema.
And where does valuation fit in terms of conviction and position weighting?
Yeah, really interesting question. So conviction is deliberately left to the individual manager to decide. And some of our managers, me included, for example, use risk reward as a way of looking at whether you should have a higher position or not. And risk reward really is a valuation driven idea, right? You look at how much money can I make if I'm right? how much money will I lose if I'm wrong? And if that ratio is more than 2 or higher, I have higher position weights in that stock. It's really simple as that. But valuation actually works its way into security selection. We think it's such an important metric that it's part of our 4 pillars for how we pick stocks. And it's much more important that you decide whether there's a valuation case for the stock or not. And if there isn't, it probably shouldn't be in your portfolio anyway, before you get into the idea of sizing positions.
And this podcast is called Compounders, and I see plenty of love out there for the types of businesses you're investing in. How do you avoid overpaying for these companies?
Yeah, it's a great question. Unfortunately, in this market cycle, Toll is full of compounding businesses, and I don't think I need to tell you, Ben, about the power of compounding. It's the yeah, I knew a CEO of a real estate company who used to have a compounding table on the back of his business card, and that's how he really believed in it. And I think it's very, very, very powerful. And it's almost a way of saying to investors, like, listen, this is a great portfolio of companies, just own it for the long run and you'll do really, really well. But the problem in the marketplace, especially right now at this stage in the cycle, is valuation. And often these companies, the market isn't stupid. It understands that there's a high multiple for these businesses.
Yeah.
What I do is, and this relates to the durability of these moats, is I just spend most of my time thinking, what could make this multiple go down? What's the downside risk here in this multiple? And if I don't think that there's a massive downside risk in all of my analysis and valuation case, I'm making sure that I can build a case that's irrespective of a re-rating of that stock. So I assume multiples will stay the same. Now, there's a way, you could also say maybe multiples drift down and you have to have a higher hurdle for earnings and other forms of growth to deliver the outcome for investors. But I just assume it's flat, but I spend a disproportionate amount of time, because what can happen with a lot of these businesses is if you have cyclical issues, okay. But once you have cyclical issues with doubts about the structural nature of these businesses, you can rapidly get a derating. And that's what I'm trying to avoid when I'm picking the security. In terms of building a valuation case where these stocks rate, I never do that. I think that is a dangerous place. And to be honest with you, this comes from experience. I've tried previously buying good businesses that are cheap with the idea that they become great businesses and re-rate. And these are very, very rare. And you're better off buying great businesses at maybe slightly higher multiples than the market, but letting compounding take care of it and making sure that you don't mess up that great business gets derated because it's actually a good business masquerading like a great one.
You have a slide in your deck that discusses edge. There are thousands of people who cover a company like Visa. How do you think about developing an edge on a company that is so well appreciated and covered?
Yeah, look, I think it actually starts by the fact that what you said, we have edge as one of our 4 pillars. Right? The first 2 pillars of our stock selection process focus on downside risk. So we're buying hopefully companies with good operating bases and companies that have solid balance sheets and cash generation. If those 2 criteria aren't met, we never buy any company. But in terms of establishing the upside, it's looking at valuation case, which is what we discussed. But finally, we ask the difficult question: what's my edge? Because you can spend all of your time making a great investment, but you need to understand why you have an insight or a view of the market or of that particular company that is different to the rest of the market. And so we ingrain it into our investment process. We make sure that we ask that difficult question. And if you can't come up with it, it probably shouldn't be in the portfolio. And so what we're always trying to do is making sure that that's there in the analysis notes and the work that we do. And of course, there's lots of different ways you can analyze edge. Behavioral edge, there's analytical edge, there's informational edge. Now, as you say, with a company like Visa, informational analytical is probably a bit weaker, but something like behavioral edge is a real powerful driver in the stock, because there are things that are going to come and go for Visa, but it's an incredible business that's delivered so much value for its customers and the shareholders that I think people maybe underestimate the longevity of this particular business as it builds out other areas where it can apply the same technology and the same value add that it's brought to the core payment system. And that, I think, is the thing that's being underestimated. There is a discussion out there in the marketplace behaviorally that people think that this growth can't go on. And I think that's maybe where we are different. And that's really why we're invested in it.
The total ETF has a heavy weighting to the US. I'm curious about what that's a reflection of. Is there just more monopoly businesses in the US? Is there something structurally, different about the kinds of moats you see outside the US? I'm just curious about why that heavy weighting.
Yeah. So look, we're positioning Toll as a US fund. It has near 80% of the fund is invested in US stocks. But its benchmark and the way we kind of look at monopolies is from a global lens, because when you're trying to pick out the best possible business, you can't just look at one geography. I think the truth is some of the best quality businesses are in the United States. There are loads of great businesses in Europe and Japan, but if you're trying to say, I want to pick the 32 best, most durable, most dominant companies out there, the US just has more of them available, and more interesting ones, and more that are really understand this kind of compounding and value creation that can come from investing in the same business that has a fantastic moat. And so that's probably the explanation. It's partly bottom up stock picking, as in when we decide which stocks, that's what the result is. Partly because the strategy of the fund is really try to focus on the US as much as you can. And really that's kind of the end result is the portfolio you see.
And I'm coming from a background where I've spent a lot of time in smaller companies and small cap and now the microcap world. I'm curious why there are no stocks with under $10 billion market cap in the portfolio.
Yeah, it's a great question. Look, I think there's loads of interesting, smaller, kind of monopolistic type businesses. But generally, what I've tended to is that when you start to narrow down that idea of tangibility combined with dominance, combined with durability, you tend to see, because you need businesses that have built scale already a little bit. And so you tend to gravitate towards larger companies. I mean, if I told you monopolies, you probably don't automatically think a small cap company, right? And it's that I think is part of the reason why there are mostly large companies. The other part is sort of, I'm reasonably happy with that positioning, but I think because I kind of thought large caps would do better than some of the smaller caps. Funnily enough, we're looking now quite carefully because the valuation disconnect, especially in the United States, but also everywhere in the world, between large and small is so great, and that there are definitely interesting companies, especially in places like electricals, like small areas where they're selling this particular niche type of thing that no one else can produce because of some technology advantage, but also distribution advantage. But it's that tangibility point that becomes a bit difficult when you're smaller, because often smaller businesses will have, it'll maybe be brand, they're growing really fast, but is that really a strong competitive advantage? Or it will be some sort of intellectual property or technology that we think is maybe doesn't have the same durability as some of the businesses that we're invested in. So it's part of the process. I think we're going to add a few small caps over time, but really it kind of makes sense for us to live in the larger cap space because that tangibility dominance tends to live there a bit more.
Zooming back out for a second, you talked about not wanting to create ETFs that are really short-term in nature, or that you're just chasing the next, whatever the flavor of the moment is, like meme stocks. But you also are betting on certain themes, whether it's, kind of the obesity side or the reshoring fund that you guys have. I mean, how do you assess the risk that those themes don't last or play out as you would expect, and then you have a whole strategy dedicated to something that didn't end up playing out the way you expected? Like, how do you assess that risk as you're launching new products?
Yeah, it's a great question, and I think really it's the one thing that's going to differentiate Tema long term versus maybe some of our competitors. What we're trying to do is we're trying to spend a disproportionate amount of time upfront analyzing the investment case for this particular theme or area. So you take obesity, we spend a lot of time thinking, is this really going to be the biggest thing? And this, by the way, we conceived the obesity fund well before the select data came out, when loads of people were saying that this is just going to be a fad. Yes, the share prices have done well as well. So there was an element of perception of hype in the marketplace. And well before you saw the actual start of rise of like Novo Nordisk and Eli Lilly as share prices. Look, what we thought is, we think this has legs, right? Because we thought if you look at the scientific literature, there's loads of information about this. And this is the kind of level we're going into, right? We're not sitting here being like, we think it's great, let's just launch the product, we'll figure it out later. We really thought, this has legs. There's enough opportunity as well. And that's a key thing, right? That it's just not narrowed down and just, of course, you have Novo Nordisk and Lilly, but I think this market is going to be big enough to sustain 3 to 4 players. What are those players going to look like? Are there enough companies in the market that we can invest into back to be in this theme? And also, you notice that we have cardiometabolic, so we're also focused on the broader, longer-term trend of biotechnology businesses focusing again on primary care. This idea of treating very, very large, difficult to treat diseases at the doctor level, not at sort of specialized hospitals or things like that. And we think that biology is ripe for a modality shift here as well, right? With genetic medicine as being a prime example of that. So if you put all of that together, you can see a much longer term theme here, right? And it's basically got legs, right? And so we think, yes, this structural growth here. Yes, we think there's an investment merit. Then we spend a lot of time on valuation, exuberance, and we make sure that those metrics aren't through the roof, right? And they often are in some of these things. People get overhyped. But, this is pharma, right? Things move a bit slower. This isn't technology or, 3D printing or metaverse or something. Things are just a little bit more stable because the investor class that looks at this space is just a lot more measured in their approach. And so we thought, yeah, this is great. There's lots of opportunity here. Let's launch the fund. Once you've launched the theme, yes, it's called GLP-1 obesity cardiometabolic fund, but the reality is that we can adjust within that, especially with that cardiometabolic bit, as the theme evolves. And this comes from the power of active management as an approach to this. Because if you were to launch a passive fund exposed to, the obesity space, you'd put in the winners of today, not necessarily the winners tomorrow, whatever else came to your mind as like, okay, that's exposed to the theme. As I said, often not the purest exposures either. There's loads of mistakes made in that area. And then you'd rise and fall with those stocks. That's it. You're not going to change them, right? Because they're the obesity companies. Whereas an active manager can look at that situation and be like, okay, maybe there's 40, 50% upside left in Novo Nordisk and Lilly. And at some point, I will switch those away into other companies. And so my firm belief as CIO of Tema is that people will come and invest in this fund because of the interest in the obesity space and the growth that will come from it. But the fund will power ahead because of those other broader themes as they build out and the dynamic of the theme changes. And American reshoring, all of the funds that we've got are very much in that same vein. And I really, really firmly believe this is my personal mission within Tema to deliver this kind of outcome for investors. And that is very, very different to all previous kind of thematic area exposed funds, because often they live and die with whatever that happens to the theme. And I think that's a mistake.
You talked extensively about the benefits of ETFs, and transparency is one of those. But I could also make the argument that if you guys are successful in what you're doing and these ETFs start to scale, the transparency allows for copycats and for people to say, just to change the ticker a little bit and have a similar theme. How do you think about that? I mean, is it that's kind of a good problem to have, or does it limit the AUM you can rise? How do you think about the rise of copycats if you are right and as differentiated as you guys hope to be?
Yeah, this is a great question. And obviously it would be a fantastic problem. What they always say, right? Imitation is the best form of flattery. We sort of, if you look back at ETFs, they've been around for a while, right? And active ETFs have also been around for a while. It doesn't happen as much as people think it does. This whole idea that the transparency means people can copy your strategies. I think this is something that, I come from an institutional investment world. You publish your holdings every quarter with a delay. Nobody really knows what you have in your portfolio. You don't have to disclose anything. That has its advantages as an investor, but the reality is that maybe those advantages are just perceived, right? The truth is that 13Fs, and if you're like a quality long-term investor, people can see your holdings anyway, right? And this copycat idea, we think, doesn't happen in the marketplace as much as everyone makes it out to be. The other thing is that in what's quite clear in the ETF world is it's the ease, with which you can invest, right? So you would never go and copy this portfolio yourself. I mean, it's just too much work to mimic it. Neither would you necessarily buy the number two. Like, why? If you've had a good investment outcome and often, you've locked in capital gains, whatever they might be, you would never switch over to a competitor product, even if it was a little bit cheaper or whatever you have you. And so what we think is that there is a real barrier to entry you build if you deliver a good investment outcome for investors, something differentiated. And sure, maybe there'll be copycats looking at your portfolios, but that's just an extra hurdle of work for the end investors. They are not going to be interested in doing that particular thing. But it remains to be seen because this is a new market. It's growing very, very fast. By some estimates, it's about $700 billion active ETF market today, which is just 5% of the total ETF market. So maybe this will change over time. But what we've seen to date is there's not been as much copying. Probably are aware that it's possible to have semi-transparent and non-transparent ETFs, but these are just not that popular with investors. Investors come for the transparency, they like it, and we think that that's where you should be as well as an ETF, institutional grade issuer.
And as you think about scaling this firm and adding new strategies, maybe more focus on the internal ones versus working with external managers, which I know you guys are working on. What does it take team-wise? Do you need what do you have? Do you have analysts? Do you have associates? Like what is a structure of an active ETF manager look like versus someone you said coming from the institutional investment world? How is that different, if at all?
Yeah. So look, on the investment side, there's pretty much no difference, right? I mean, what we're trying to do is deliver great investment outcomes, deliver alpha for investors, pick the right stocks. So all of our investors have loads of experience investing in the market, 30 years in some cases. They know what they're doing. They don't really necessarily need analyst support. They haven't had it for a long time. In our life science funds, we are building out two areas. One is analyst support, because I think it's really important. There's a lot of area to cover, and these topics are quite complicated. So we're fortunate enough to have an analyst there, but we're also building out a life science advisory board made of key opinion leaders. And we're super happy, for example, in our obesity strategy to have the man who basically discovered or pioneered, let's say, GLP-1, Professor Jens Host, who's joined our advisory board. And he's one of two people in the world that basically discovered GLP-1 and made it a thing. And he's been involved in drug development as well, which is really helpful. So we're building expertise there. And I think that's the important thing. Maybe one of the things we're differentiating ourselves to maybe other asset managers is building more and more expertise within these areas. The second bit is technology. I think on an investment team, you can't basically build a modern investment team without technology, and we're using it in every aspect that we can. And we're constantly experimenting with new things and new ideas, especially machine learning and some of these AI tools. They're not amazing yet, but they will be, and that's why it's important to keep improving them. And we're working with someone on risk management, for example, as an area. And so those, in terms of scaling that, that's exactly the same thing. And as you are aware, you know the investment business really well. Every incremental dollar of AUM doesn't necessarily require you to scale that, but it requires time to build that core of expertise. I think on the distribution side and on the marketing side, yeah, you need people there. And that's where we're different. I mean, I would say that the marketing strategy is that we have is so different to what you see in a classic asset manager. And that requires people, ingenuity, inventive ideas, and just vision to be like, I'm going to do something different within the rules, obviously, of what are set by FINRA in terms of leveling the playing field and delivering a good outcome to investors, but really different of how we get at people. And so I think that part, once we're building a scalable engine there that is hopefully going to be valuable to another asset manager as well. And that's the idea of how you scale this firm, why it's different in that sense.
If we're having this conversation again in 7 years, what would success at Tema look like to you?
So I think there's this sort of firm answer. I think from our firm perspective, what we're trying to do is become the leading independent asset manager in ETF space. And we want to bring the best offerings within the verticals that we're focused on right now, which is healthcare, alternatives, and other areas that we're working on as well, like, for example, retirement. And we want to be the leader in that space. Like, we want to win, and we want to produce the best investment products, and we want to also be seen as this, I don't want to go as far as saying it's the vanguard, but really the player in this space. That's what I think about. I look out 7 or even further years out. From the investment perspective, my mission is to deliver great investment outcomes, and that's what I was trying to say, especially in areas that historically have not had great investment outcomes for investors, and especially for investors that have previously not experienced what a good outcome looks like. And that is really what I believe in as CIO of Tema. So if you combine that together, that's what I think in 7 years, hopefully we're having this conversation, we're looking back, we've delivered great offerings in healthcare, alternatives, retirement, and some of the areas that we're focused on. And we're the leading independent asset manager within ETFs. And that's really our mission.
Yuri, this has been a fascinating discussion. And frankly, I've learned a lot about the vision and the execution and the philosophy and process. We'll close with a question we ask all of our manager guests. What is the most underappreciated aspect of the investment opportunity in front of Tema today?
Yeah, so great question. We're going to need a second to think about this because I'm an investor, right, at heart. There's just so many interesting things out there. But I think, if I maybe go back to the strategy that I run, I just think that there's this underappreciation still, despite all of the evidence that quality businesses are the best place to be, that maybe that there's an underappreciation of understanding what a really fantastically great business looks like versus what a good business looks like. And then maybe an underappreciation in the study of moats. Now, there's a lot of excellent investors that use moat investing, but they're sort of behind the scenes, they don't talk about. And I just think that there's this enormous investment opportunity in terms of toll and the companies that invest in just delivering that message and that analysis and that work. And I hope to sort of lots of content behind it as well that investors can read. I think that's one big investment opportunity out there that's there. I think for Tema as a firm, the thing that people have really just not understood yet is the rise of active ETFs and actively managed strategies. I think everyone in the investment world is just still they've not woken up to it. And I talked to loads of people, in New York and San Francisco, all of these places. And the moment you mention ETFs, they think SPY, QQQ, passively managed strategies.
Sure.
They don't even know it's that bad that you can have an active strategy in ETF. And I think that in 20 years, there won't be any mutual funds. Everything will be managed in ETF format. ETFs, as I said, are just 5% of the market, but they're taking 30% of flows, at least so far year to date. I think and people haven't woken up to that. And that is actually one of the greatest investment opportunities out there for people to build great businesses. And, we welcome other people as well, right? We don't want to be the only ones because it's an enormous opportunity.
Well, it sounds like you're building something fascinating. You have some very well-respected backers. I know you're working on some innovative things that we may have you back on to talk about soon. But I think, it sounds like the foundation and the fundamental structure and strategy are very sound. So we're going to be following Tema very closely. Yuri, thank you so much for being on Compounders.
Ben, thank you so much for your time, and hopefully this was useful for your listeners.
I'm sure it was. Thank you. Thanks again.
Thanks.